Hello, welcome to It's Your Smarter Money with Laura and Steve from Atlas Fiduciary Financial. Today we want to talk about 22 and really just do a whole year-end review on what we think happened. It was a tough year. It was challenging. And, we saw higher interest rates, we saw inflation, we saw recession fears, we saw a war, and they all
Yeah.
set the stage for nervous investors and for markets that turned downward.
Yeah, we saw repricing in many of the markets, both domestically and internationally this last year. Repricing really means we saw a decrease in their value.
Right. And so we have some slides to share with you. And one of the first slides really does point that out, where it shows actually this slide, where it shows the various major markets, really the major equity markets and the major bond markets. It doesn't show our alternative or our enhancer asset classes.
Which we will show a little bit later, a little bit, some of them.
They actually help save the day because, as you can see, all the equities and all the bonds did not do well.
Yeah.
So down, the U.S. stock market down between 18 and 19%, depending upon which index you use as the benchmark.
Right.
And international down, emerging markets, real estate, all of them down, and even fixed income down. And so we probably should talk a little bit about that too.
And by the way, last year was considered to be one of the worst years for bonds. And, the Wall Street Journal, they said since the 1800s. And, those that were in bond mutual funds and bond ETFs were particularly hard hit for various reasons. And we have covered that in some past videos, and perhaps we'll cover it again, why they were hit so hard, as opposed to owning individual bonds. And so here we show you the S&P, a basic ETF model that includes 60% in a S&P 500 ETF and about 40% in a well-known bond ETF, the Vanguard bond ETF. The symbol's B and D, and it's really modeled after the Barclays bond aggregate. And as you can see here, that particular combination, which is typically considered to be a solid portfolio by many investors and many mutual fund families, including Vanguard, really got hammered last year. It was down about 16%. In fact, it was down almost as much as the S&P. And by the way, that prior slide, which showed the market as a whole being down 19%, that was the Russell 3000. So here we're using the S&P 500, which is a slightly different index.
I want to say something about that 60-40 model, Steve. That is we often, when a new client comes to us, this is the model that they have. It seems like all the major wirehouses, whether it's a brokerage house or a bank or a lot of advisors, think that this very, very simple-minded portfolio is adequately diversified, and it just simply is not.
No.
They're under the impression that bonds and stocks are negatively correlated. And while that might have been true for a period of time, most recently, over the past 20 years or so, it was the fact 40 years prior. So bonds and stocks have times where they're correlated and times when they're not correlated. And so you can't just use that one single asset class as a diversifier. And this is why, it's actually a real shame that people hired somebody to manage their portfolio, and this is what they did for them. And I'm sorry, there's no excuse for it. Anybody that's educated in finance should know better.
So, I really focus on two reasons why a lot of the firms do that. Number one, they're lazy. And number two,
they're not educated in finance, Steve.
That's what I was going to say. Number two, they're not using the latest mathematical tools. And when I say latest, some of these mathematical tools go back to the 1950s, although they've been, dramatically improved, and we use the dramatically improved versions, but they don't use those tools. So they just are lazy to throw you in a 60-40 portfolio. And it may look good over an 8 or 10-year period. It may perform better than a diversified portfolio, but boy, all it takes is that 1 year, and suddenly you're down, in this case, what, 8% more than, like, for example, our Model 6 was down roughly about 10% last year, 9.94%. And that's because of the additional diversification that we have. And that's a big difference.
Right, it is. And the Model 6 is definitely more competitive than the average 60/40 model. It's actually, we would say a Model 4 is about the same level of return as the 60/40. But the Model 6, we're approaching a return similar to the S&P when we're targeting that level of risk. And so, we expect it not to perform as badly as here. It performed basically half the downturn of the S&P in a bad year, yet in a good year, it will perform sometimes as good, sometimes even better than the S&P.
That's correct. Yeah, and then one of the reasons why the 60/40 might have outperformed the diversified model over the last 10 years, they may not have natural resources, which did perform poorly up until 2 or 3 years ago. Also, international, the S&P dramatically outperformed international, and we may very well see a rotation back to where international performs better than domestic. And I think that's apt to happen now, because if you look at the valuation for international stocks, they're much more realistic than a lot of the domestic stocks.
International small cap, which we'll talk about.
Yeah.
So this chart actually is a chart that has been created over the past 40 years. There's a research consortium up in Cambridge, Massachusetts, named Callan, who has produced this chart. And we love looking at this chart. We've been using it for many, many years. This particular chart only goes back to 2008, but of course, we have the data where it goes down back much further. And what they've done is that for any given year, starting in 2008, what was the best performing asset class? That goes on top. And then each
they're ranked by performance each year. Yep.
Right. So again, in 2008, you can see when everybody said, "Oh my, everything was down," everything was not down. Fixed income was not down. It was the best performing asset class, and it certainly helped us a lot in that time period. But you can see that in any given year, a different asset class serves as a leader. And so it's very, very hard to pick the leader. And you can see sometimes these asset classes are the lead, and sometimes they are the bottom. Do you have anything else you want to say about that? Because we could spend an hour talking about this.
Yeah, I just want to mention real quickly, if you look at this, and I've just looked at it quickly myself, I don't think there was any year where fixed income was, there was only 2 years in which it was negative, and that was 2021, where it was down about 1.5% here. But last year, fixed income got crushed. It was down 13%. So it didn't provide diversification value last year, fixed income. By the way, that's going to change going forward, because now yields are higher. We're going to talk about that. But I think the other thing here, too, to consider is that commodities perform poorly over the whole time period. But in the last couple of years, commodities really outperformed, and they actually helped our models.
And on the converse, REITs were one of the top performing asset classes 6 out of the 15 years. And last year, REITs were the worst performing asset class. So it's very, very hard to gauge and to guess what the asset class is going to be next year. But I'm going to take a wager, and this is completely just between us making our roulette wheel bets. I bet you small cap and REITs, those two bottom asset classes, I bet you they're going to do pretty well in 2023.
I think that's probably a good guess.
But actually, the really reason why I wanted to show you this chart was this came from JP Morgan. They do a study where they collaborate and they find a bunch of institutional and average advisors who are using an asset allocation model, and their asset allocation model does include much more than the 60/40. It includes some small and mid cap and some REITs and some commodities. And here you can see in 2022, they said the average asset allocation was down by 13.9%. So again, 18 to 19% for the S&P.
Yep.
For a 60/40, it was somewhere around 15%. For an average asset allocation, down 13.9. And for our Model 6, down 9%, Steve.
Yep, that's about right.
I'll take that every day. I think we're doing I think we're doing something right here.
Yep, I think so too.
Mm-hmm.
So this slide is, I think, really useful to look at, and it looks at the performance of various, I would call, sub sectors of the market based on size, or whether it's a value or a growth stock. And so you can see here that on the 10-year, growth beat the large cap growth beat large cap value, and we mentioned that, and that is relatively unusual. But now we may be starting to see rotation back to value, because now over the 5-year, value is actually ahead of growth, and last year it was way ahead of growth.
The 5-year,
it was actually up a little bit value,
and last year, yeah.
Yep. Over the past 1 year, value was up slightly and growth was down 37%, that's devastating. If you have only growth stocks, that's devastating. It could take you a long time to come back from that. So what's also interesting is that if you look at small cap value, we're starting to see the same effect there. We're starting to see more of a rotation toward value, even in the small cap area, and also in the mid cap area. So there's a lot we could say about this. Laura, do you have any comments?
I guess I'll just keep it short and say that we've seen the hit. If you look at the data, if you look at the history, value has outperformed growth for more times than not.
Yep.
But there's time periods where growth outperforms. This past decade, there
Yep.
was some outperformance, especially at the end of the decade. And then the prior, back when we were talking in the 90s, especially the end of the 90s, we had a real surge in growth. But then it came crashing down, and what we saw from 2000 to 2010 was value took its place again. So
that's right.
It's an interesting dynamic that goes on there.
And we did mention earlier, we were talking about this earlier, Laura and I, and I think we saw something similar happen, possibly not for as long a period of time, where growth outperformed value probably in the late 90s, probably 3 to 5 years, and in part because of the internet boom. And then we saw that rotation back to value, and growth went down dramatically when a market correction began around the year 2000. It lasted to roughly 2002 or 2003, but value did hold up better in that decline. And we may be seeing that again now. We think it's a strong possibility. And this shows rolling 3-year returns for value versus growth. And you can see in yellow how much growth was outperforming value on a rolling 3-year average. But now you start to see that little bit of purple on the right-hand side, where value is starting to outperform growth on a rolling 3-year average, which kind of is backed up by the previous slide, which we showed you. And so one thing is always important to look at with the equity markets is evaluation. And that one of the key measures of evaluation is how much you're paying for a dollar of earnings, also known as price to earnings ratio, and what the pricing is now in relation to the past. And so, for example, we see here for small cap stocks here, we see that the price to earnings ratio for value is roughly 15 to 1. In other words, you're paying $15 per dollar of earnings. And the average over the last 20 years has been about 16.8. So it's below the average, actually. Whereas for small cap growth, you'll see it's still pretty high. It's about 25. It's below the 20-year average, but it's still pretty high. But look at large cap growth. It's still above the average, which has been 18%, or 18, I should say. And the price earnings ratio right now is still at 21, which is still pretty high. So I can't say the market is cheap right now, but I do think, and we mentioned this, that there might be sectors of the market that may perform better going forward, and that could be value based on these valuations.
Value and also small cap. And
Small
that's
cap,
funny, by the
yes.
way, price to earning ratio is one metric of value. There's other
Yes.
measurements as well. There's price to book, there's price to sales, there's free cash flow, there's a
Yep.
variety of things. And we try to take advantage of all those different metrics, not just price to earnings. And you have to be careful about price to earnings also, because right now these are the earning projections going forward
Next
today.
12 months.
But there may be some additional rocky road depending upon how the economy does. We do expect some slowing of the economy that could potentially affect earnings. So this is something
Yeah.
we're keeping an eye on.
And by the way, we actually have one particular ETF that doesn't even rely on book for pricing. They rely on enterprise value because there have been studies done, and a lot of companies they have a lot of assets that actually don't show up on our balance sheet. They're intangible assets. And so we have a fund that looks at cash flow in relation to enterprise value, which includes the intangible assets. And so here you see market pullbacks over various periods of time. And what we're seeing here for this pullback, in part, we're going to show it a little bit later. There was a repricing of the stock market in part because of the rise in interest rates and also because of inflation spiking. And historically, about 40% of the return on the S&P 500 has been because of dividends, and probably about 60% of growth because of changes in price and increases in the stock price. So dividends have always been an important part of the return on the market. And dividends, there is a relationship between dividends and interest rates. And so because interest rates rose so strongly, there had to be a repricing of the market to provide better dividend yield. And so I think that's part of what's been pressured the market to reprice is the rise of interest rates. And in fact, you have to get better yield on dividends in relation to the stock price. And we're seeing that here now. The dividend yield is up to 1.8%, at least at the end of last year. But I want to mention that could be affected by earnings. And if earnings do decline over the next few months because of a recession, there's a possibility these companies could cut their dividends, and we could see that decline merely for that reason, which could also lead to a further repricing of the market. We can't make that prediction, but it is a possibility.
Something to watch.
Yep. And you can see here that various Treasury yield curves, and the one on the top is the yield curve from 3 months ago. That's in purple. And the one right below it is current. And you can see that, which is interesting, the 5-year Treasury yield has actually declined. It was around 4.2, 4.3 range. It's now down to maybe 3.55 roughly. But what we're seeing here is what people call an inversion in the yield curve. And you'll see that short-term rates are actually higher than long-term rates. And a lot of people view that as a potential signal that a recession's on its way in the near future. We're not saying that's a fact, but a lot of people do view it that way when they see that inversion. But what's interesting, you can see the enormous increase in rates from one on the bottom would be roughly about 2 years ago. It looks like 2 years ago. It's amazing the difference in rates.
Yeah, I mean, rates just year over year for like a 6 month went up by over 400, something like 450 points.
Yes.
And 1 year as well. So it's been significant, especially over this past year. I just wanted to mention the little red dot on the left-hand side there where it shows how high the short-term part of the curve is.
Yep.
We just bought a Treasury yesterday, I think it was, for something like 4.75 or something crazy like that, which, certainly Treasuries are a great place to maintain some liquidity if there's a purchase coming through, or, so for those folks that are looking and have told us, we're thinking about taking some money out to buy something, we're buying a house, we're buying a boat, whatever it is, we're starting to pull it and put it in a liquid instrument like this where we're still getting a return, but it's to be available for them when they need it.
Yes, that's correct. And we're seeing some really good rates in the first time in, I guess, I'm guessing 10 years right? I'm guessing we could look back and research it, but it's probably 10 years. And so here, this is interesting from the aspect that we plot here the 10-year Treasury rate in relation to the CPI, and we go all the way back to 1980, the Consumer Price Index, that is. And it's interesting that typically you seem to see a lag between the spikes in the inflation rate and changes in the 10-year Treasury rate, in part because typically the Federal Reserve reacts to increases in the Consumer Price Index with rate increases. And I think there's typically a lag from the time they start to raise the federal funds rate, which is the only aspect that they can really control. And we see 10-year Treasury rates increase. And so, but now what's interesting, we're starting to see a decrease in the inflation rate. I think the December number was around 6.45%, which we show here. And we're starting to see a slight decline in the 10-year Treasury rate. So whether that'll continue or not, who knows? I have no idea. But I will say, if we do see a continuing dampening in or decrease in energy prices, I do expect inflation to decline. And that's because energy really trickles throughout the entire energy prices affect the entire economy. I think they've identified 6,000 products that actually rely on oil or natural gas as precursors to the production process. For example, fertilizer relies on natural gas as a precursor to produce fertilizer, but it also is incorporated in transportation costs. So one of the key drivers of inflation, at least initially, is energy prices. Later on, it can be driven more by wage increases and unions demanding higher salary. But I'm hoping, I guess the idea is inflation does not become endemic in the economy. We may be less likely to see that type of those types of forces that will continue inflation or keep it high. Hopefully, we don't. So, and here we actually show the S&P's price to earnings ratio in relation to the 5-year Treasury rate, and you can see there's a slight correlation here with a slight lag. And when the 5-year Treasury rate went up, you can see that also the price to earnings ratio of the S&P went down. That leads right in that. That follows what I mentioned earlier about that repricing, and in part in the market, it had to reprice with interest rates as interest rates increased, and investors need to get a higher dividend yield, and so the only way they're going to get that in lieu of companies raising dividends is for prices to come down, prices of stocks. So, Laura, do you want to talk to this?
Sure. So we have the individual asset classes that we wanted to talk a little bit about. The first is just to talk about U.S. stocks. And you can see that all the U.S. stocks, regardless of the category, were down. U.S. stocks were down more than international developed countries, but less than emerging markets, which really took a hit. Although we don't use emerging markets. You can see the large cap. If you just look at large cap, the third one from the top on the right-hand side, down 19%. Compare that to large cap's value, which is the top one, 7.5%, versus large cap growth, 29%. You can see the difference between value and growth. And unfortunately, there are quite a few people that were in a lot of growth stocks, whether it be things like Tesla or Nvidia or even Microsoft and Google, and they saw their portfolios go even worse. 19% they would have been happy with. They're down in 29, maybe even more. So and we see the comparison too with small cap value versus small cap growth. The big differential. Small cap value at 14% versus small cap growth at 26% down. And the U.S. stock market does make up 60% of the overall capitalization in the world. So you want to have exposure to a lot of U.S. cap, but you want to be smart about it. And the thought about taking whether you want to be more value focused, now's the time to start really considering that, because it's clear that there's some opportunities here.
And by the way, we've almost always had a value focus here. We've always bought into the research that showed value outperforming growth in the long run and with less risk. We've always bought into that concept. Yeah. By the way, you mentioned Tesla. I think Elon Musk is the one that's probably crying the most. I think they said he lost more money than any person in history now, about 200 billion, because of the decline in price of Tesla. Amazing.
That's a whole nother conversation.
Yes, it is.
um, and then 30% of the capitalization in the world is developed markets. So it's really only 10% that makes up the emerging markets. We don't feel compelled to play in that space, but we do like developed countries, and we think that there's a place
Yep.
for developed stocks, both large cap as well as small cap. We tend to focus more on value with small cap because it is a very small cap are those companies that haven't really fully proven themselves. We've taken a more of a blend position in the large cap space, but we continue to monitor, and you may actually even see us introduce. We're looking at a couple of funds that are more tilted towards value.
Yes.
You may see them in your portfolio in the near future, and we can talk about
Yep.
that as well.
And by the way, right now value is actually fairly priced. I think I should say international in general. I think the last time I saw it, I think the price to earnings ratio is in the 8 to 10 range. It's better, really better value than domestic right now. So we could see rotation back to outperformance of international as we saw from probably year 2000 to probably 2005 or six. And we've always had international, so it's nothing new for us.
And
REITs got crushed last year.
yeah, we saw that other chart that we showed you, the Callan chart. It was the worst performing asset class, and we of course we're concerned about that, and we spoke to a variety of REIT
Yep.
managers and tried to really understand what was going on there. In fact, it looks like U.S. REITs even outperformed or underperformed worse than international REITs. And we
Yes.
have you in both. You have exposure to both global as well as domestic real estate. But one of the questions that they kept coming up with, and Steve, maybe you even want to talk a little bit about that because they kept saying,
Yep.
these companies are collecting all this cash and their balance sheets look beautiful, and something's going to change.
So the thing with REITs is, first of all, they recover quickly when they recover, and I've seen it before. In fact, we looked, and I think they're up. I think we said about 5.5% already for this year, about 3 times the S&P. The S&P is up roughly 1.6 as of yesterday's close. But most of these REITs have what are REITs? Okay, what are the REITs? They're actually real estate investment trusts or companies that own real estate. They invest directly in commercial properties, industrial properties. It could be cell phone towers, storage facilities, you name it. They have a lot of cash flow. And so what's happened now is because of the cost of construction, it's gone up so much because of inflation. A lot of these REITs are less susceptible to competitors because it's going to cost so much money to build competing properties that it's going to be a while before they're going to be able to do that. Additionally, a lot of these REITs in their leases to the entities that they have as tenants, they have escalation clauses that are affected by inflation. So their cash flow is going to continue to grow. And so they have a very high cash flow, most of these REITs. And so we expect them to recover probably pretty quickly. And we expect them probably to be one of the better performing asset classes in the next year or two, potentially.
And they're collecting rents from all these different apartment buildings, senior living facilities, warehouses.
Yep.
Yeah, anybody that's renting something knows rents are going up, and they're benefiting from that.
And by the way, I want to mention this is one of the few areas where we find that it's advantageous to have an active manager. And we've gone over the numbers in some Morningstar studies, and the reason is because there is some rotation in the real estate market, and some of it's long term. So I don't think retail may ever be quite the same as it was, for example, 15 years ago, because we've seen so many malls that are having issues or losing anchor stores and things of that nature because people buying the internet. But what they do instead is they're in industrial properties or in healthcare facilities, cell phone towers. So that's why it makes sense probably to have an active manager here with REITs, which we do have.
That cell phone tower is probably what kicked them into the negative also. Cell
Yes.
towers did not do as well either because that was, of course, related to technology.
Yep.
But and commodities were the superstar this year. Commodities were up by I think it's 19%
Yeah,
by our benchmark, and our fund was actually up even better. And you can see the mixture, and we use a lot. The choice that we use seeks to get exposed to as many of these commodities as you see in front of you here. So we're not taking a bet on, zinc or copper or oil. We're taking a bet on more of an inflationary push that might
that's
affect
right.
all of these items. So
Yep.
our particular holding, I think, has somewhere around 30%.
16. It's a basket of 16 commodities.
Right. So about 30% in the energy types of heating oil, gas oil, Brent crude oil, that kind of thing. Maybe about another 30% ish in the agricultural items like soybeans and corn and sugar. And you can see these are all up. And then, of course, we have some of the metals, which are down, the industrial metals like aluminum and zinc, and even gold was down as well. So for those people that just want to own gold, there you go. Such a good year.
Gold has never really been a great hedge against inflation. We've shown that in a couple past slides, or I should say videos. What's interesting is anybody watch that movie Trading Places, which you have to bring that up. They try to corner the market in orange juice futures. And you don't even see orange juice anymore or pork bellies as commodities, which is interesting.
Right. And then we're back.
And of course, fixed income got crushed, right, Laura, as we mentioned.
And this is, just a quick snapshot to show you, the difference between, on the right-hand side, we're seeing the more less investment grade bonds are offering the higher yields. We tend to not want to go in that area. We'll tend to stay more in the municipals, for example, but they are offering some decent yields right now.
They are.
Know, we showed you that Treasury yield where while we think the yields are still very, very attractive, they've gone down over the past year. So while people might not like the 10-year yields compared to maybe the shorter yields, they might say, why are you going to go out 10 years? Well, we may never see these 10-year yields again. So there's a question on how you want to play this overall duration, the duration of your bonds. And but we're always staying in the quality, the AAA, AA type of sovereign debt. We tend to steer away from corporates. They tend to. I was actually talking recently to somebody that's been in fixed income all his life, and that's all he does. And he was saying how he feels like junk bonds are safer than the corporates right now, which was interesting, Steve.
Well, that's interesting.
The corporates are taking on way too much risk, and he was concerned with the actual corporate, even if they said they were investment grade. We want to be careful with things.
Well, his guess could be right or wrong, but we can't depend on those guesses.
Yeah.
And by the way, I want to mention here now, for the first time in 10 years, I think we're going to start to see some real assistance to our portfolios from the bond component of it, because we're finally starting to see yields that are closer to the traditional yields on fixed income. So that's going to certainly help our portfolios going forward.
And this is just the global market as well. It's showing you that most of the developed countries have this an inversion as well, with the exception of Japan. If you go all the way to the small print on the left-hand side, the changes in yield, you can see there's that 430 point spread over a year for the 1 year Treasury. But you can see that also appears in most of the other countries, with the exception of Japan.
Yeah. And one thing I meant to mention earlier, that there's a series of rate increases that the Federal Reserve has pushed through over the last year and a half, I think has been the quickest increase and the most over such a short period of time in history, which is astounding. They've been very aggressive to raise rates to try to fight inflation. So here we see what did hold up in our client portfolios last year and helped, I would say, dampen the downside capture, or the amount we actually declined in relation to the S&P. And these are the three main categories. We show actual holdings here, but these are actually categories. The first was natural resources, and we show this in terms of dollar growth.
The Invesco Optimum Yield is diversified. It's a long title, but that's natural resources. Sorry, Steve, I didn't explain that. And this is $10,000. And how it grew over the past year, and it's in comparison to the last one, which is the S&P 500, which clearly did not grow; it declined.
Yep.
Sorry.
That's okay. And we have two other asset classes. Here is the private equity fund we use, private equity mutual fund, and they own about 80 to 90 pre-public companies. In other words, companies whose stocks aren't listed on the stock market, but they can gain access to those companies in various ways. And one of their top holdings right now, I think it's 2 or 3, is actually SpaceX, just to mention a company that a lot of people are familiar with, which is actually, they were disruptors. They've totally disrupted the launch industry. And so it was up slightly last year, which is pretty good for, what are pretty aggressive investments. And also our alternative lending fund, which invests in probably 200,000 loans to individuals and small companies. They were up slightly as well last year, maybe a 2% return on it, which is great considering the bond market, right?
Yes. Yes. And so this is actually an interesting chart because it shows, going back to the 70s, how consumer sentiment has bottomed out at the low parts in the market. And we've seen the actual behavior. There's other charts that show at the bottom of the S&P, the actual cash flows that are being pulled out of the market. And it goes to show you that market timing is never the right way to go. It makes a lot of damage to people's portfolio. And so if you're feeling a little worried and concerned, and rightly so, perhaps, I mean, there's a lot of bad news on TV, and there's a lot of things happening that could potentially create some anxiety in you. You really need to take a step back and try to understand what you're holding. And if you need our help, we'll help you understand what you're holding, why you're holding it, how we've taken this valuation tilt, why it's the best solution for you. And if it's not, we'll try to help you find what's the best solution is. But now it's not the time to go running for the hills and selling out, especially, looking at this chart, you could see that it seems like we're almost staged for an opportunity to sell at the wrong time.
Yep. And by the way, I got a couple of emails from mutual fund companies that actually consolidated a number of predictions from various so-called experts in 2021 regarding what 2022 would look like. Almost every one of them was wrong. Every one of them. You don't ever believe predictions, and that's why we will not try to predict.
However, again, while your portfolios have clearly held up beyond what you would have held up if you were just in the stock market, or if you were in a 60-40 portfolio or that type of thing. The facts suggest that investors should really focus on what they own, their valuations, and not how they feel about the world. Maybe don't even watch some of this stuff on TV. I'm starting to try to cut the news.
Or just view it as entertainment, not investment advice.
Right. So in terms of 2023 and your expectations, let's start really looking at how we're positioning you to protect against risk and be there as when the markets start turning up, like the real estate market and even international, which we're already seeing some favorable. We don't know if it's going to persist, but we're seeing some favorable movement. We are. And by the way, Steve and I, we spend a lot of time with the academics and the professional investors. And there's consistent expectations that we will see slower economic growth, not just in the United States, but internationally as well. And that we will see potentially a slowdown in inflation, although we're not sure exactly if it's going to go back to where it was. It may still stay a little elevated, but hopefully it's not going to continue to grow at the same accelerated rates that it was growing in 2022. And that, of course, will prevent the Fed from making these big moves with interest rates. So, you know, again, that's part of the reason why we don't know if we're seeing the best of interest rates or if they'll possibly settle down a little bit further. In terms of equity returns, we're absolutely not expecting, nobody in the academic or professional world are expecting to see them grow at the same pace, really, as they were in the recent past. But there still is opportunity, and we showed you how there seems to be some opportunity if you are selective in value and maybe small cap and
small cap
international. And we talked about bond yields, and we do expect them to be a contributor, which, you know, in the past, we were more focused on, okay, what is the role of this asset class in our portfolio because it's not giving us return. And we're going to say, oh, yes, it's to help protect the portfolio and diversify away and, you know, just another asset class. Well, we're actually expecting it to take on an additional role as being a contributor. So that's good news. And our enhancer asset classes are also continuing to provide true diversification, not just that simplified idea behind a 60-40 portfolio, but a much broader idea where we're looking for many sources of risk that don't behave in the same way, so that regardless of what happens in 2023, we're still protected while we're still set to potentially ride some additional return in the positive direction. So, again, we're really happy that you joined us. And if you have any questions about this video or any questions about your portfolio or any suggestions, we are very happy to hear about them. So please feel free to contact us. Thanks and take care. Bye.